Hi friends. Now in this session we will discuss very important and slightly difficult topic from CFA Level 2's derivative section. This is the swaps fixed to floating. So in this video we will discuss only fixed to floating. In the next video we will also see the currency swaps. Right? So let's see first the basic idea of swap. We already discussed the swaps idea in the CFA Level 1 also. But here again I will give you the quick overview of how the swap works and then we will see the pricing and the valuation. Now let's assume there is a party A. This party A is interested in paying fixed rate on the loan amount. Okay, let's say this is 5% and wants to receive floating from party B. Okay, now the floating rate is decided on or based on the settlement date rate. Okay, so here this 5% payment and receiving the floating rate is for some purpose. This party might have the situation where this party is like paying interest on loan, and let's say this is the floating rate loan. Okay, so this is the floating rate loan. So what happens here? This party is paying floating rate and also receiving floating rate. So this particular leg will be zero, okay, because you receive the same amount and you pay the same amount. So there is no impact of this particular floating rate loan, and is paying 5% fixed rate to the B. So net this party converted its floating liabilities into the fixed liability, and this is what's happening inside this swap. So here for us, we have to see how the pricing of this particular fixed rate is done, how the settlement works and so on, and what will be the settlement value or the calculations. Also, you need to understand, let's say this is the swap of 3 years. Okay, so on this is time t0, time t1, time t2, time t3. This is your start date of the swap. So on this particular date, there will be, let's say, you have the term structure and the spot of 1 year, spot rate for 1 year is say 4%. So because this is spot rate of 4%, which is a floating rate, this particular payment will be made by this party A. Sorry, this particular payment, the 4% will be received by the party A and received 4% and will be paid 5%, because here we are assuming the 5% as a fixed rate, and this will be paid because this is the payment of 5% and receipt of 4%. So net payment required is only 1%. Net pay is required only 1%. And remember, this is the based on notional principal. We call here this principal like 1% of what? 1% of notional principal. We call this as notional principal because it is not exchanged in fixed to floating case. When there is a fixed to floating case, the swap, we don't exchange the notional. It is notional. Like this is the amount, on this amount we will do all the calculation of receiving the percentage rate and the paying the percentage rate. That's what happens. Then on this T1's date, you will have again 1 year spot. Let's say this is 5%. So for T2, this party will be receiving, because this is a floating receiving party, will receive the 5% and again will be paying 5%. So net no payment will be exchanged in this particular case. And let's say at this particular point at T2, the spot rate is equal to 6%. So here this party will be receiving 6% and paying 5%. So net receipt of 1%. Okay, so that's how this works. So here again, the first question is how to calculate the spot rate. How to calculate this 5% fixed rate. Spot rate is like available, observable rate, right? Now see. For this, we'll start with the illustration, and with the help of illustration, again, we will handle all the problems or the questions here. So let's say there is a party, again, the same party, who wants to pay fixed rate what I will do, I'll simply write this particular party wants to pay fixed rate, okay, and obviously will receive floating rate. This makes this particular party as a fixed rate payer, the swap payer. Fine. And duration is, the swap duration is 3 years. And then notional amount, or simply notional principal, is $1 million. Fine. Now, here we have the current spot rates. Because the duration is 3 years, so we will need the spot rates of 3 years. So this is time, this is rate, and 1 year maturity rate, 2 year maturity rate, 3 year maturity rate, and we are taking 5%, 6%, and 7%. So on this day, when the party is entering into the swap, the party knows about these floating rates or these spot rates, which is for 1 year 5%, 6%, and 7%. And this particular party wants to ensure that whatever rate is being committed today is the fair rate. Fair rate simply means like there is no net gain or loss for this particular party. So if there is net gain, obviously that party will be like happy to take, but the counterparty won't be ready to give the same rate, because it is like the advantages for the party, the other party, right? So we have to calculate the rate, the particular rate, which gives us the final value, which results into the no profit, no loss situation. And that's why we call that at inception, there is no value in swap. That is, the value of the swap is 0 at the inception. After that, there will be some value in between, right? Now, how to do the calculation? So we have the SFR formula, the SFR calculation formula. So SFR is calculated as 1 minus final discount factor divided by sum of discount factors, all discount factors. Now this is the formula. I will give you the explanation of how this formula is derived and all, so don't worry about it. Right now, just remember this is the formula. So for this, what we need these discount rates. Now how to calculate the discount rate? Discount rate is again very simple. You learned it in the CFA level 1. So for the first year, we will call this as discount factor 1. For the first year, discount rate is 1 divided by 1 plus 0.05 to the power 1. For the second year, discount factor 2, it is 1 divided by 2 year spot rate is 6%. So 1 plus 0.06 to the power 2. And then we have the discount factor 3, which is 1 divided by 1 plus 0.07 to the power 3. And you have to simply solve this and you will get the answer. I'll do the calculation. Just a second. 0.05 divided equals to 0.9523, or we can take it as 24. Then 1.06, it is 0.8899, and then 0.7 divided 3, 0.8163. So these are the discount rates applicable for each period. Okay, so first year, second year, and third year. And then we have to calculate the sum, the total of discount rates. So total is 0.9524 plus 0.8899 plus 0.8163. This is 2.6586. Okay, so we got the total. So here we can directly put it into the formula. So in formula, it will be 1 minus last rate, this particular rate, 0.8163 divided by the total, 2.6586. and then you have to do the calculation. So 1 minus 0.8163 divided by 2.6586 multiplied by 100, it is 6.90%, and this is your SFR. This is the, whenever you see the swap rate is this particular rate, the SFR rate. So a fixed rate. So this fixed rate is required to ensure, as we discussed, to ensure that there is no profit or loss for the any party. But why? Now remember, this is fixed to floating rate swap. Here we are taking the fixed rate payer and then floating rate receiver. So if I say simply, you have one particular bond where you have to pay, like this is bond issued by you. So you have to pay a fixed rate on this particular bond, and in exchange, I will give you one floating rate bond, and on that you will get the floating rate payments. So you would like to ensure that on the day of exchange, whenever we are making this particular swap of bonds, one bond is a fixed rate payment where you have to make the fixed rate payment, and in the another bond you will receive the floating rate payments. So you want to ensure like, okay, whatever I am committing on this day, the value of the bond is equal to 0. The value of this exchange is equal to 0. And that's what happens in any swap. So remember, whenever you see any swap, remember there are two bonds position. When you are the fixed rate payer, whenever you are making the percentage payment, this must be the situation where you have borrowed the funds or issued the bond, obviously effectively the borrowed funds. And whenever you are receiving some rate, this means you have invested in it. So wherever you have invested in it, it becomes your asset. Whenever you have borrowed, it becomes your liability. So liability and asset in this particular bond form you have to think, and the bond structure you have to think. For these solutions, for solving the questions in a faster manner, always think any swap as a two bond structure. One is the investment, one is the issuing, that is a borrowing of funds. Now, here we have this swap rate formula, and again this swap rate is given by the this term structure. Now let's see what happened here. Let's assume for now you have to invest $1 in a particular bond. We know how to do the pricing of this particular bond. So SFR is the fixed committed rate which we will be paying for 3 years. So you will pay SFR for the first year, then SFR for the second year, then SFR for the third year, or for right now, like for the understanding purpose, we will assume like you are receiving. Okay, so if you are in the receiving end, it feels like more natural. So you are going to get the SFR for the first year, SFR for the second year, SFR for the third year. This is nothing but your coupon rate, right? So fixed coupon rate. And in the end, you will also get the principal. So for now, we will assume the notional principal of $1. You can take the $1 million or doesn't matter. And we know if I provide you this particular cash flow, then whatever you are paying today should have the same value. So this whole structure should have exactly same value based on whatever you are paying today. So when we assume the notional of $1, so automatically you are paying $1 today, and in the end also you are getting the $1 your return. And this is exactly what happens in the swap. So in the beginning we assume that you have, when there is a fixed rate payment side, so we assume you receive the notional, and in the end you return that notional. This is the assumption. So to do the calculation, obviously we will use the discounting. 1 plus first year's rate to the power 1, 1 plus second year's rate to the power 2, because it's discounting for the 2 years, 1 plus 3 years rate and 3 years discounting, and for last also it is 3 years rate and 3 years discounting. Fine. Now I can write this particular term as SFR into 1 divided by 1 plus R1 to the power 1. Effectively this is the discount factor for the first year, right? Then plus SFR discount factor for the second year, plus SFR discount factor for the third year, plus 1 divided by, plus 1 into discount factor again for third year, because in the third year you will be getting the coupon. Remember, SFR is the coupon, so you'll be getting the coupon and also the principal. Here our principal is $1. Now again the $1, this is what you are paying today. Again our assumption is the RHS should be equal to LHS. LHS is what I am paying and RHS is what I am getting in return. So both should have equal value, then only it makes the sense in investment, right? So otherwise this is not beneficial for us. Using this principle, we can do the calculation of SFR. Now see, here we have the SFR. We can take SFR common. So here you have the SFR, then we have the discount factor 1 plus discount factor 2 plus discount factor 3. I'm assuming you know this much maths, plus 1 into discount factor 3 is simply the discount factor 3. Discount factor 3, because we are taking the 3-year swap. So here the third discount factor is our last discount factor, right? If you take the 4-year term, then 4th year discount factor will be your last discount factor. Now we will solve this for the SFR. So first we have to get that this particular discount factor 3 into the LHS. So this will be 1 minus discount factor 3. And here, this is the whole term, DF1 plus DF2 plus DF3. I can simply write it as summation of all the discount factors. So I will divide this by the discount factors summation. This will be equal to the SFR. This is how we got the formula. Now you can write this formula into the Z term. So SFR is equal to 1 minus Z last divided by summation of all Z's. This Z is simply the discount factor. And this is the formula you have to remember. This particular explanation is not as such required for your exam because not the part of learning objective. But yeah, this is very important. You have to remember this. Now remember what's happening. Here we are taking the annual rate, right? Because we are taking the annual rate, this SFR is annual SFR. But if you are taking, let's say, the spot rates which are semi-annual, so you are provided with the swap structure which has, say, 6 months, 1 year, 1.5 year, instead of 3 years, it is 1.5 year, but 6 monthly settlement. 1.5 year with semi-annual settlement. In this particular case, we will have the term structure which will be like this. For the 6 year, let's say rate is 1%. For 1 year, 1.5%. And for 1.5 years, it is say 2%. So in this particular case, if you calculate the Z values, that is the discount factors for each, and then you calculate the SFR, if you calculate the SFR using this, again, you will apply the same formula. For you, the last Z value will be this 2% discount factor. And I assume like you all understand how to do the calculation here. Because remember, these are the semi-annual rates. So first you have to get the semi-annual component. So this will be 1 plus 0.022% divided by 2 because it is semi-annual rate, and to the power 3 because it is for the 3 periods. And that's how you will get a discount factor. For this, it will be 1 divided by 1 plus 0.015 divided by 2 again, because again, we have to first convert it into the semi-annual, and to the power 2 because it is for the 2 periods, semi-annual periods, right? So 2 semi-annual periods are in 1 year. And for the first, it will be, for the first part, it will be 1 divided by 1 plus 0.01 divided by 2 to the power 1, because first semi-annual period is the 1 semi-annual period. As simple as that. So we got this. Once you do the calculation, so you have the discount rate, you will use the discount rate, and then you will calculate the SFR. This SFR will be periodic. for the 6 months. This swap fixed rate is the 6 months component. Again, using the same formula. All Z's. If you get a question where the question asks you to calculate the annual SFR, for this you have to take the periodic SFR and then multiply it with the number of periods in 1 year. So simply in our case, we are taking the semi-annual. So 2 periods are there in the 1 year. If we are taking the quarterly, then there are 4 periods in the 1 year. So you will multiply SFR periodic, which will be the quarterly SFR, which is effectively like what you have to pay. And then you have to multiply it with the 4, because in the 1 year, total quarters are 4. So quarterly payment, for quarterly payment, SFR quarterly multiplied by 4 to get the SFR annual. But remember, your all calculations are done as per the SFR periodic, because ultimately whatever is the settlement period, based on that you have to make the payment. And that's the thing you have to like take care of when you are doing the calculations or solving questions in the examination. Let me undo this. Yeah. Okay. So remember this. Then we'll come back to our original formula. I'll just minimize the not required portion. I hope this is visible for you. This is the formula we will need. So I'm setting it aside, and fine. So this was the first part, how to calculate the SFR. So this is the reason, like this is the method using which you can calculate the SFR. So for you, as I said, like you have to just remember the formula. Then next part. In the next part, we will see the settlement, fixed payment. Next question here is, what will be the first fixed payment? First settlement. Remember, where is our timeline? This T0 settlement will be done at T1. So for this, again, it is very simple. What is our SFR? SFR is 6.90%. 6.90% multiplied by, what is our notional value? 1 million. 6.90% multiplied by 1 million. And you can simply solve this. Just a second, you have to drop the 2 zeros. 690, 69,000. So this is your first settlement. Fine. Now you got the first payment. Now remember, this is the fixed payment you have to make. But then there is also second question, because remember, you are paying 6.94% and you are also receiving some amount. And receiving is based on this particular floating rate, which was decided in the previous settlement, that is at the time of T0. At time T0, 5% is the rate for the 1 year. So we will use that rate as the floating rate, which will be received by this particular party in this particular case. So the net payment, is simply what you pay minus receive. So you pay 6.90% minus you receive 5% multiplied by same notional amount is equal to 1.90. So it is $19,000. Okay, that's it. This is very simple, net payment part. Okay, then the most crucial part. valuation of swap, that is fixed to floating swap. Now the valuation is again like simple. You have to just focus on what's happening in the structure. Important note here, in this particular exam, you have to just calculate the valuation of the swap or the value of the interest rate swap only on the settlement date, only on settlement date, and not in between. So you can do the in between calculation also, but it is not covered in the CFA's curriculum. So you have to only focus on, like, if this is the timeline and these are your settlement dates. So T1 is the settlement, T2 is the settlement, T3 is the settlement. So you have to do the valuation on these dates only, not here in between. Okay, so this is not the part of your curriculum. If you have to do the settlement in between, it will increase the complication, because now you will have the last coupon date, next coupon date, and it is a bit of hodgepodge situation. So maybe that's why there is no like in between settlement date valuation of the swap. So here you have to only focus on the last, like the proper settlement date valuation. Here, if you want to calculate the, or if you want to value the swap on the settlement date, so it is very simple. The swap value is calculated using the formula, that is summation of Z multiplied by SFR new minus SFR old multiplied by notional amount. If you are using the periodic situation, then you have to multiply it with notional amount. Then for the because you are SFR, this is assuming like this is the annual SFR converted from the periodic SFR. So if this is the situation, then you have to use the days divided by 360. For example, if you have say semi-annual swap, so with the whole part, we will multiply it with the 180 divided by 360 to get the valuation. Okay. So here anyway, you are using the annual rate, so we don't have to bother about it. Now, think from the very simplistic perspective. Here you are paying fixed rate. Now let's say if your SFR new, this SFR new is, you have to recalculate the SFR again on the settlement date, because again you will have the next spot rates. So if you have situation where new SFR is higher than your old SFR, then automatically your value, like your swaps value will be increasing, because your commitment rate is say 5% and new SFR says you, like in this situation, the rate would have been like the 6%. So you're not paying 6%, you are paying only 5%. So 6% versus 5%. You have committed to pay 5%, but you are saved from this 6% rate. So 1% is your gain. Okay. So this is how we understand why the structure is here like this. But in reality, like if you think properly, whenever you are making the commitment of the fixed SFR rate, we will call this as the coupon rate. Okay. So whenever you make this particular commitment, you are effectively, as we discussed, this is the bond situation. So you have one particular bond, right? So bond A, bond B, this is the comparison of both the bonds are going on. If, like, because the exams time, like the questions time is very short. So if you can do the valuation of bond A and the bond B, bond A is your fixed rate payment bond, where again you will have the new discount rate, you will have the coupon rate, which is now the SFR, where coupon is equal to SFR. Use this, do this particular bond A's valuation. Then you have the bond B, which is a floating rate bond. Do the valuation of the floating rate bond. Now you have the two bonds values. One is your asset, one is your liability. Calculate the difference. That is the value of your swap. If you follow this method, you will get the exactly same answer, or you can use this particular formula, again the same answer. Remember, this particular formula can be used only when you are standing at the settlement date. If you are not standing at the settlement date, if you are in between the settlement dates, then this whole structure is of no use. But again, we don't have to bother about the problem, because it is like you will get the, like, it is mainly related to the settlement. If you are doing the valuation in between, then you have to follow the bond method, which is this method. Okay, so this method is important for the in-between valuation and also the settlement date valuation. But for the settlement date situation, we have the shortcut. That's why we will go with this particular shortcut. Okay, now for this, we are assuming, and one more thing, as I said, like you have to remember, if the new SFR rate or the rates increases in general, automatically your new SFR rate will increase, but your old SFR rate is like your committed SFR rate is the lower rate. In this particular situation, you will get the benefit because again, you have committed to pay low. Now the market is like moving up. So that's your benefit. If you take the reverse situation, if the SFR new is going down and your commitment rate is like the higher, then you are at the loss. So you have your swap will have the negative value. So for this, we will assume like after 1 year, so 1 year lapsed, okay, and at settlement date, you have to do the valuation. You have to calculate the value of the swap. So for this, again, we will need the spot rates. Remember, initially it was 3 years. Now 1 year lapsed. Now you have only 2 years left. So for 2 years, it is 6% and 7%. Again, we have to follow the same formula, that is SFR, but this is SFR new. And again, we have to calculate the Z last minus Z1 minus Z last divided by sum of all the Z's. So here we have to calculate the Z. So for first, it is 1 plus 0.06 to the power 1. You have to solve this. 1 divided by 1 plus 0.07 to the power 2, because it's for the 2 years. 1.06 divided equals 0.9433, and the second one will be 1.07 divide equals 0.8734. Okay, and then sum total of this is 0.9433 is equal to 1.8167. So here the last SFR new is equal to 1 minus last SFR is 8734 divided by sum total 8167. Simply solve this. 1 minus 0.8734 divided by 1.8167, and it is 6.96%, and our initial rate was 6.9%, right? So swap value is equal to sum of all Z's is equal to 1.8167. See this, sum of all Z's at the settlement, okay, multiply it with the SFR new 6.96 minus old 6.90 multiplied by notional amount is 1 million and multiplied by number of days, because here our calculation is the annual. It will be 360 divided by 360, effectively nothing, like the 1. Okay, now 6.96 minus 0.90, this is percentage multiplied by 1 million. Multiplied by 0.06% multiplied by 1.8167. So your value of swap value is equal to $1090. So this is the value. Okay, so again, very simple thing. Mainly, like, if you don't want to get involved in the whole fiasco of doing all the calculations, my recommendation is just follow this method. Otherwise, if you are interested, then you can do this. So let's take the bond A is equal to, we know our initial rate was 6.9%, right? So we will take the 6.9% of 1 million divided by this spot rate 6%. This is, I'm giving you the additional explanation. This is not required for the exam, just an additional explanation. Then use the discount rate. New discount rate is 6%. 0.06 to the power 1 plus 6.9% multiplied by 1 million. 1 million divided by 1 plus 0.07 to the power 2, again here, plus 1 million. That is, principal will be returned, and you will also get the coupon, which is equal to the SFR. And here we are calculating the coupon only. What is the dollar amount of the coupon? And then you have to do the discounting and calculate. Here you will have the bond value. Remember, you are fixed rate payer. So this bond value where you are taking the fixed rate, this is the side, because you are the payer. This is the borrowing side. This is the liability side. And then you will have the bond asset side, which is the floating rate. Asset side. Here the catch is, because we don't know, we know the floating rate, but we don't know what will be the floating rate for the throughout the time. So what we do, we take 6%, because right now we know for 1 year spot rate, means at time t0, we have the 6% as a rate. So this particular floating rate will be applicable for the next settlement. So this is the coupon you have to pay, multiplied by 1 million. And then you use your 1 million part, and then you do the discounting. Okay. And that's how you can do the second part's valuation also, and you will get the answer. Not a big deal, but ignore this particular part, because unnecessarily this is complicating the discussion, which is not required. In case you are interested in how to do the evaluation in between, so in FRM, the full curriculum, the full swap valuation is required, like in between, on the settlement date, all type of swap valuations are required. So you can watch those videos and you will get the proper understanding. Fine. So that's all from my side. In the next part, we will see the currency swaps. Thank you for watching this video. Bye bye. Take care.